Hi guys, in this video I'd like to explain the basic concepts behind stock options, and I will follow that with examples on how to use them to make money. I will also explain why options have such bad rap and what to watch out for when you buy them. This is the first video in a series of videos I'm planning to do on options and option strategies. And if you like this video, give me a thumbs up, subscribe, and hopefully after watching this you will have a better understanding of what options are and how to approach them. Personally, I trade options a lot, so if you'd like to see option trading in action, check out my Patreon. The link is in the description of this video. I will also include links to a few books on options that I often recommend to beginner traders. Let's go! In order for you to understand the concept behind the option trading, I'm going to use a short story as an analogy. Back in the year of 332 BC, yes, before Christ, there was a man named Thales of Miletus, who was a great astronomer, philosopher, and mathematician. Thales was a brilliant guy, and by observing the stars and weather patterns, he predicted a huge olive harvest in the following year. He then realized that olive press machines would be in high demand following such a big harvest. Thales thought that he could turn a huge profit if he owned every olive press machine in the region. However, he didn't have that kind of money. Instead, Thales came up with a brilliant idea. He used a small amount of money as a deposit to secure the use of every olive press in the region during a certain period of time. So he didn't buy the olive presses, but he bought the option to use those machines after the predicted harvest. As Thales expected, the harvest was plentiful, so he sold the rights to use these olive presses to people who needed them, making a fortune. By controlling the rights to use the olive presses through the option, even though he didn't call it the option then, Thales had the right to either use them himself when harvest time came, exercising the options, or sell that right to people who would pay more for it, selling the options for the profit. The owners of the olive presses, who obviously didn't know how the harvest was going to turn out, still secured profits through the sale of the options to Thales. So the idea of options is not new and used by people for literally thousands of years. Now let me give you an example from today's real world. Imagine that a piece of land is selling for $100,000 and you think that at the end of the month, called expiration date, it can be worth $110,000. I emphasize that you think that the value of the land may go up, but you don't know if it actually will. Let's also say that unfortunately you don't have $100,000 to buy this piece of land today. But there is one thing you can do. Instead of buying the whole land, you can simply buy a contract or option to buy this land for $100,000, called the strike price, pretty much locking in this price through the end of the month. And the option to buy this land for $100,000 may cost you, let's say, $2,000, called option premium. So you didn't buy the whole land, you just made sure that you can buy it at the end of the month for a price of $100,000, even if the price went up any amount. Let's say by the end of the month or the expiration day, the price of the land is $110,000. There are two things you can do. First, you can exercise your option and buy this land for $100,000. In this case, you will own the land for $100,000 plus the cost of your option. If you do that, you may then choose to sell it immediately for $110,000 or to continue to hold it. Second thing you can do is to simply sell your option for $10,000. Your option will be worth $10,000 because it's the difference between today's price and option strike price. In both cases, you will be up $8,000. So basically you've invested $2,000 and you've made $8,000 on your investment. That's 400% return. To summarize this example, you're buying an option to buy the land at a certain price. That option is called a call. You paid for this call $2,000 and you're risking only $2,000. If by expiration day the price of the land is above the strike price, then your call is in the money and will be equal to the difference between the strike price and the price it's trading at today. But if by expiration the price of the land is below the strike price, then the price of your call will be zero and you will lose $2,000. But your losses are limited to the price of the call. Everything I told you about buying a piece of land translates into stocks. Same thing, on the stock market, one contract equals 100 shares. Let's do an example. Suppose the stock is trading right now at $88 and you think it will be above $90 by the end of the month. Instead of buying 100 shares of the stock and locking up $8,800, You may buy one call contract of the stock with the strike price of $90. Let's say this contract's price is $1.25. Since one contract equals 100 shares, you would invest one contract, which is 100 shares, times $1.25, which is $125. The point here is that instead of investing $8,800, you're now investing only $125. So buying calls is a cheap way to profit on stock's upward movement without risking much capital. Now what about puts? Puts are very similar to calls, except the main idea behind puts is to profit on stock's downward movement. So when you buy calls, you're hoping for the stock to go up, but when you buy puts, you're hoping for the stock to go down. With puts, just like with calls, you have two choices. First, you can just sell your put, hopefully for a profit if the price of the underlying stock went down. Or second, you can exercise your put at the strike price and sell the stock at your strike price. Selling a stock without previously buying it is called shorting the stock. Yes, I know what you're thinking. How can someone sell the stock without previously buying it? Well, believe it or not, that's allowed. When you try to sell short, what happens is that underneath your brokerage company will find shares for you to borrow and sell. After you've sold it short, you're hoping for the shares of the stock to go down so you can buy those shares back at a lower price, keeping the difference in the process. So when you buy a put, you reserve the right to sell short the stock in the future at the strike price. Just like with calls, when you buy puts, you have two choices: to sell the option itself or to exercise it. For example, let's say XYZ company is trading at $100, but you think that the price will go down in the next month. So you can buy one put at $100 strike price, let's say for $2, and that put contract expires this month. If the price of the stock drops to $90 by the end of the month, your put will be worth $10 and you will be making $10 minus $2 that you originally paid for the put equals $8 difference, or $800. You may choose to sell this put right away, or you may try to exercise it at your strike price, which is set at $100, and becomes short the stock. Now, when I talk about buying puts and calls, I told you you have two choices of what to do with it. Either sell it or exercise it. But I cheated a little bit. There's actually a third choice. The third choice is to do nothing. In this case, if you bought an option and that option is in the money by the expiration date, then you will be automatically exercised. But if that option is out of the money by the expiration date, then it will simply expire worthless. Let's take a look at the example of buying an option and don't do anything with it after all. Let's say you bought one call of some XYZ company stock expiring this month, strike price $35 for $1. Let's assume that today is the option expiration day and XYZ stock is trading at $37.25 per share right now. In this case, your call is in the money, so if you don't do anything, you will be automatically exercised and get 100 shares of XYZ stock at $35 per share. Now, let's assume that at expiration, XYZ stock is trading at $34.75 per share. In this case, your call is out of the money, and if you don't do anything, then by the end of the expiration day, your option will become worthless or zero, and you simply lose whatever you've originally paid for this option, which is $1 times one contract, or 100 shares, equals $100. How the options are valued and why options get such a bad rap? In terms of valuing option contracts, it is basically all about determining the probabilities of the future price events of the underlying stock. The more likely something is to occur, the more expensive an option would be that profits from that event. So, for example, some biotech is about to receive a ruling on its experimental drug at the end of the month. Most likely the options on this biotech stock will be very expensive because probability for the underlying stock to make large moves on the day of the ruling is very high. At the same time, the less time there is left until expiration, the less value an option will have. This is because the chances of a price move in the underlying stock diminish as we draw closer to expiration date. If you buy a 1-month option that is out of the money and the stock doesn't move, the option becomes less valuable with each passing day. Since time is a component to the price of an option, a 1-month option is going to be less valuable than a 3-month option. This is because with more time available, the probability of a price move in your favor increases, and with less time available, the probability of a price move in your favor decreases. For instance, an option strike that expires in 1 year will cost more than the same strike that expires in 1 month. The same option will be worth less tomorrow than it is today if the price of the stock doesn't move. Volatility also increases the price of the option. For example, back in March and May of 2020, markets became super volatile. The uncertainty about the ongoing illness and closing of the economy caused investors to buy puts on S&P 500 to hedge themselves against the potential downward movement of the index. Hence, the prices of S&P 500 puts went up in value tremendously at that time. Therefore, the greater the volatility, the greater the price of the option. Options trading and volatility are linked to each other in this way. So why do options get such a bad rap? Let's start with the fact that only about 10% of the options are exercised, 60% are closed out, and 30% expire worthless. However, if at the beginning of the month you bought an option which is out of the money, more often than not, by the expiration date, it will lose some or all of its value. A lot of people who get burnt on options are inexperienced traders that turn to options without fully understanding what they are, how time decay each day obliterates the value of an option, and especially an out-of-money option. Many times these inexperienced traders are drawn by the cheapness of an option, but as you may know, cheap price is often fool's gold. Let's take an example. Suppose a stock trades at $10 and you purchase a call at the $15 strike that expires in just a few days. You could purchase such a call with a very low price per contract, but unless the stock is exceptionally volatile, are the odds really with you that it will make a 50% surge in just a few days? More likely than not, you will have just made an incredibly risky bet. So even though the total sum of money you put at risk may be still small, the chance of your losing that money will be very large. And that's why options have gotten such a bad rap. As I've mentioned before, the time decay in options, and especially out-of-money options, is pretty severe, and many beginner investors underestimate that and consequently get into deep trouble. However, if used correctly, options could be a great tool to make money in any markets. I hope you liked this video, guys, and if you did, please smash that like button, subscribe, and like I said, this is just the first video in a series of videos I'm planning to do about options. So until next time.